From an equity perspective, as we look at 2023, we do think that corporate earnings estimates are too high at this point. Right now, consensus has the S&P 500 earnings growing 3% year over year, and we think this is too high. There are some puts and takes across sectors, and so while we're not outright negative, we are a bit more cautious on a sector like consumer staples at this point. Keep in mind, the vast majority of the earnings growth experienced by firms in the sector in 2022 was through price realization, simply passing on higher prices down to end consumers, not volume growth. And so as we look at 2023, with dissipating inflation, this tailwind is removed, and we're more cautious on these businesses' ability to grow. Taking a step back and looking at the broader market, just because we have pressure on corporate earnings does not mean that we will absolutely have an outright negative outcome from a stock price performance. More specifically, we looked at data going back to 1955 and found 17 years in which year-over-year earnings growth for the S&P 500 was negative. In 13 out of 17 of those years of negative earnings growth, the S&P 500 actually exhibited a positive total return. So again, just because there's earnings pressure, that doesn't mean that stocks have to end the year outright negative, because ultimately, a stock is worth what an investor is willing to pay for it, not just a factor of its earnings stream alone. Also operating as a tailwind as we enter 2023 is inflation. Inflation has been a buzzword of 2021 and 2022 and has ultimately pressured input costs for corporations and has served as a drag on profitability. As we look at 2023, we see inflation having already peaked and coming down rather rapidly throughout the middle portion of this year. And what that results in is a tailwind for equities. It's a tailwind for earnings potentially, but more specifically, as we look back through periods in history, when inflation is high, call it over 5% year over year, and declining, the equity potential growth, at least on average based on history, was 19% valuation expansion. So it's not necessarily all an earnings story, it's more about investors looking far out into the future, and with that headwind of inflation removed, they're willing and able to pay a higher price for a share of those earnings. So we do see potential for valuation expansion coming into 2023. We think selectivity is still warranted given the economic pressure and overall softening that we've already discussed, but we do have a more optimistic view of the broader market for performance in 2023 than I think the average retail investor does.